market participants think that in the month of August, the prices are going to be 2 rupees. So it gives us a price discovery mechanism where it is the most important thing in a well functioning market. Financial investors, speculators, etc., can enter into the market.
Is India's initial approach to electricity derivatives compare with these markets?
In short, derivatives will build a financial layer over the physical market. This will, in my opinion, improve the efficiency, transparency, and resilience of the Indian power. The market were 50 to 20 years old, and with right policy and design percentage scale rapidly.
Hello and welcome. This is Shavani, and in today's session, we are going to talk about electricity derivatives. For decades, power trading in India has centered around physical supply through long term PPAs or short term spot markets on exchanges. But now, with growing price volatility, renewable uncertainty, and financial stress on utilities, the need for financial risk management tools has become urgent. Electricity derivatives are stepping in to fill just this gap. To explain how these instruments work, what problems they solve, and what lies ahead for India's evolving electricity markets, we're joined by Mr. Rajendra Abhijit, who has more than 15 years of experience in the power sector and is currently working into regulatory and compliance. So let's get started. My first question to you, Mr. Abhijit. As I just said, India's electricity derivatives are traditionally relied on physical delivery through PPAs and exchanges. So, how do electricity derivatives differ from this setup, and what specific gap are they meant to fill in current market?
Yeah. Okay. Thank you, Shivani, for that introduction. So, electricity derivatives are basically financial contracts. So, what electricity derivatives do, as you have rightly pointed out, that till date in India, our trading has been uh, 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 related to grid delivery. So, if you are trading power, you have to physically deliver that power. Somebody has to inject that power, somebody has to draw that power, and then you enter into contract. All sort of contracts are, available. Either you do a bilateral contract or you sell through power exchanges. No, but derivatives, what they do, they allow you to hedge the power purchase prices without injecting or drawing any power. For example, if a seller who is selling power in, for example, in power exchange or through short-term PPAs, if he wants actually to lock his prices, because prices in power exchanges are volatile, in short-term tenders they are volatile. So if he wants to lock at a certain price, what this generator can do, he can buy a future, or sorry, sell a future contract, and then he can lock in a minimum price. So even if the actual spot prices in power exchanges drop, the generator is protected in that sense. Similarly, in the distribution company or a big CNI consumer or in an industrial consumer, if they want to lock in their purchase power purchase prices, they can buy some sort of future or options or other financial products which are available in the market. So the core gap which electricity derivatives fill is financial risk management. You don't actually need to inject power to hedge your price risks. And this becomes even more important when we look at India power market evolution. From fixed price contracts, we are now moving to merchant market. It's a higher renewable energy penetration. Government wants to increase the depth of short-term market. So all these things are important and would be taken care if we have a thriving electricity derivative market. Yeah.
Okay. My next question is electricity derivatives are now listed on exchanges like MCX and NSE. So, could you explain how futures and options function in this context and how these exchanges support such trades?
Correct. So, just a disclaimer here, exchanges, I mean, you are right. MCX and NSC will now launch these electricity derivatives. But right now, both these exchanges are going to launch only future contracts. So, both future and options are tools to hedge price risks, but they behave very differently. Uh, for example, a future is a binding contract, is a binding agreement. If there is a future contract, the seller and buyer are obligated to settle at the expiry date of contract. So every future contract has expiry date. For example, MCX has said that they will launch a monthly future contract. So for the month of, for example, August, right? A contract will be available at MCX. Any seller and buyer can go and trade that contract. when that month gets over, right, that contract needs to be settled. For example, the discom buys a July electricity future at say 5 rupees, and the IX average turns out to be 6 rupees. Correct. So what happens is the discom has to pay 6 rupees to the exchange, but when they settle the future contract, they get back 1 rupee difference between 5 and 6. So they had bought that future at 5 rupees, right? And they bought power at 6 rupees. Correct. So their effective cost of purchase works out to be 5 rupees only. You pay 6 rupees to the exchange, you get back 5 rupees from the you get back 1 rupee difference from the exchange. So effectively your price is say 5 rupees. Similarly for generator. Now an option is a little bit different from a future contract. The option gives you a right but not an obligation to buy to exercise that option. For example, a generator buys an option contract of say 5 rupees. So the generator says, I may or may not, settle exercise this right to actually use this option. So for getting this flexibility, he has to pay something which we call a premium. So that premium may be, for example, 10 paisa per unit. So generator pays a 10 paisa per unit premium, gets that freedom to exercise that option. So how does it help the generator? It helps generator against to protect him against a price crash. For example, if the IX price was say 5 rupees, nothing happens. Generator is happy. He sells at 5 rupees, he doesn't exercise that option. But say if the price drops to 4 rupees, so generator was forced to sell at 4 rupees, but then it exercised that option that okay, I will sell this at 5 rupees, and whosoever has bought that option has to pay 5 rupees back to the generator. So what is happening here is generator is making good. So he had sold at 4 rupees. Now he gets 1 rupee additional from the market, and he has paid some premium, say 10 paisa. So in effect, he is getting 90 paisa from the option contract. So what he has got 4 rupees plus 90 paisa, 4 rupees 90 paisa. So this sets a floor price for the generator. So the in future you have to actually settle. I mean there is no two ways about it. Buyer and seller are obligated to settle at the end of the month, but in an option you have that flexibility, that freedom actually to either exercise or not to exercise that option. So in a nutshell, while future fix your price, the options gives you a flexibility but at a small premium. So both these products are used to manage market volatility.
I had a bit of confusion between futures and options. Now that's clear to me. All right. So my next question is, with rising market volatility, especially due to renewable integration, how can electricity derivatives help discoms, generators, and large consumers hedge financial risks tied to price and supply variability?
Correct. So you're very right to flag off that risk. I mean, as more and more renewable comes into the system, and as more and more sellers and buyers move towards short-term market, price volatility will increase. So, for example, we can use these financial products actually to hedge those volatility risks, basically. So, for example, discoms can, use futures to lock in their expected purchase price. So discom knows that, for example, in the month of April, they forecast that okay, it will be a peak season. There can be a supply shortage in the market, so they can, buy future, use these future contracts actually to lock in their power purchase prices. So even if the exchange spot market goes above their future price at whatever price they have bought that future, they will just pay that price. I mean, they will just settle at the future price, and they are protected from rising prices in the power exchange. And similarly for generators, if they want to ensure a minimum revenue, they can either sell future or buy put options. So that will ensure a minimum revenue floor for them. And similarly for large CNI consumers also, they will act like how discoms act, because both of them want to cap their procurement costs. So in all these cases, derivatives will improve budgeting because I know at what price I will sell my power. I know at what price I am going to procure my power. It will reduce my exposure to short-term volatility, and thus it will enable more confident commercial planning at discom level, at generator, at merchant generator level, and at CNI consumer level.
So my next question is, beyond hedging, what broader benefits such as price discovery, liquidity, or transparency can electricity derivatives bring to India's electricity market?
Yeah. That's a very good question. So, of course, the starting use case for derivatives is going to be, hedging your price risks, but the benefits go beyond hedging also. So, for example, price discovery. So, futures or options for that matter, gives you a these markets reflect the correct collective expectation of the market. So, for example, if today we are sitting in July, if the future for August are trading at say 2 rupees, correct? So this gives us a signal that market participants think that in the month of August the prices are going to be 2 rupees. So if I have that sort of visibility, that sort of price forecast in front of me, I can plan my procurement, or I can, if I am a generator, I can plan my power sale by bidding strategy. Everything I can do that. So it gives us a price discovery mechanism where because the number of participants will increase. Right now, there is no such platform where each one of us can come together and have a sort of collective reflection on prices. So derivative market will enable that. Then, of course, liquidity. Liquidity is the most important thing in a well-functioning market. A well-functioning market should have a very large number of buyers and sellers. Right. That is the basic concept behind a well-functioning market. So because these electricity derivatives do not ask people to actually physically inject or draw power, the number of participants in the market will increase. Now, traders or financial investors, speculators, etc., can enter into the market. Right. So, the number of stakeholders, the participants in the market will increase, and this will bring more liquidity to the market. Third thing, how it will help us is it will help us in planning and financing. So right now, what the problem with why people run after long term PPAs? Because these PPAs give them a revenue, uh, assurance that okay, I have sold my power at say 2 rupees for next 25 years. So bankers, financiers, they like that kind of certainty. Even if the prices are low, I mean those revenues are secured. So here, the derivative market, the financial market, gives developers the same sort of convert that they have some sort of hedging mechanism to hedge their future revenues. So this automatically make these developers more bankable. Discoms can also manage their power purchase cost very effectively if they start using these products. So they can have a better budget at the start of the year or at the start of the month. They would know how much their expected outgo is going to be towards this power purchase cost, so the budgeting will improve. Also, the market maturity will also increase. So right now we are at a place where everything is contract based. Only 6-7% of electricity traded or generated in India is traded in short-term market of our exchanges, day-ahead market of our exchanges. So, but our intent, the focus of the regulators, the government, is to deepen this market, right? So the market will mature if such kind of products are available. So, in short, derivatives will build a financial layer over the physical market. This will, in my opinion, improve the efficiency, transparency, and resilience of Indian power market.
Right. My next question is about jurisdiction. So, electricity derivatives operate under SEBI's oversight, while the physical market is regulated by CERC. So, how are these regulators coordinating to ensure smooth market functioning? And what was the impact of 2021 Supreme Court ruling on the respective jurisdictions?
Yeah, correct. So, derivatives are nothing new. The maturer power markets have these type of products for a very long time. Even in India, people have been talking about these products for a very long time. But why these products are not getting launched? Because as you rightly pointed out, there was a dispute between SEBI and CRC that who will actually regulate these these products. Right, the CRC was saying that electricity derivatives, the underlying index for these electricity derivatives is the power exchange day-ahead market prices, which are governed by the power exchanges are governed by CRC, right? And SEBI was saying any kind of financial product has to be, regulated by SEBI as per the relevant laws and regulations. So, Supreme Court in 2021 clarified that while SEBI will have jurisdiction over the financial contracts, the electricity markets will continue to be governed by CRC. So, this has brought much needed clarity and I would say division of power between the two regulators. And the impact is clear. I mean, the when this order came, the interagency, consultations increased, the products were designed, teams were formed, and we are at a stage where I guess from next week or next to next week, both these major MCX and NSC, both of them are going to launch these products in the market. So this has been a very good news for Indian power market as such. Yeah.
And who are the key stakeholders expected to participate in this market, like utilities, traders, financial investors? What are the entry requirements and how can participation be broadened?
Correct. Yeah. So the core participants, of course, are the physical buyers and sellers who buy and sell physical power. So top of my mind come the discoms because in India still almost all the power. A very large, share of power is bought and sold by distribution companies. So distribution companies has to buy in and has to enter this market for this market to become successful, right? Then, of course, there are generators, RE generators, thermal generators, all sort of merchant generators who don't want to lock themselves up into very long-term contracts, correct? Then there are CNI consumers because these people also want to, because power, electricity cost is the main cost for their product. So they want to, have access to, economic and quality power. So CNI consumers are the third important stakeholders. And as you rightly said, traders and financial intermediaries have a very important role to play if electricity derivative markets has to mature. So these people will act as market makers, they will act as aggregators, and I would say they would act as speculators too. So these people will bring depth to the market, they and liquidity to the market. As far as entry requirements are concerned, so because this is an evolving thing, we have more clarity as things pan out. But as of now, what I understand is that anybody who wants to trade into this market, they must register themselves with a SEBI authorized broker. They have to comply KYC norms and maintain minimum margin balances or other balances as required by exchanges. And for corporate players and for discoms for that matter, they may require or they will require board resolutions or internal risk management policies to be able to participate in the market. So in short, participation is open, but actual entry will depend on the risk appetite, the operational readiness, and the market literacy also.
Right. My next question is about some of the concerns in this new financial market, like liquidity awareness and risk management. So, what risks should early participants watch out for, and what steps are needed to build trust in the market?
Right. So, of course, when the market is new, the first concern of all the stakeholders is whether the market is liquid or not. Because to a large extent, the liquidity dictates whether the prices will be stable, and you can have a fair forecast of the prices or not. So, if the market is not liquid and the markets have a wide bid ask spreads, it will make it will, the stakeholders will find it costly to enter or exit any position. So, if that is the case, very few stakeholders would actually want to trade in the market. And the important thing here is Discoms as the biggest buyer of power in the India has to participate. Otherwise, the markets will remain shallow. Second challenge which early adopters will have is the lack of internal readiness. See, this market is new to India. right? We are used to operate in a certain way. We are not, and power sector companies and discom etc are not used to trade financial products where there is no delivery, but you have to manage your risks etc. You need to have internal risk policies. You should have trained persons who actually understand what these products are, because as the financial market will evolve, the financial products will become more and more complex. So you need to have people, manpower, who actually understand these things. And then you have to have a very strong governance mechanism to manage derivative position. So it's important that people do not start speculating on prices, and these guys make huge losses etc, and then that will be a very bad thing for continuation in these markets. Then there is a perceived financial risk also. How in futures, the I was just going through the MCX circular of starting of this derivatives from, I guess, from 10th of July. So what they are saying is that futures will involve daily mark to market losses or profit settlement. So what happens is, if I have bought a future for say August, so on 1st of August, at the end of first day of the August, exchange will look at what was the average price of IEX for that day. For example, price on 1st of August was say 1 rupees, correct? My future, I have bought a future for 2 rupees. So there is a gap of 1 rupee, right? I have to exchange prices were lower, my prices were high. So maybe exchange will ask me, to to pay 1 rupee extra as margin, as a security margins, right? So that thing will happen on each day. So each day there can be losses, some days there can be a profit. Even though the position is settled at the end of the month, this profit and loss thing will be visible to the players at the end of each day, and people will be asked to adjust their margins accordingly. So this daily profit or loss thing, if it's visible, this optics may be misunderstood by management, by boards, or by auditors in a scenario where derivatives are not very well understood across power sector. Once these markets mature, when these products mature, people have knowledge about these things. This may not be a very big challenge. Then there is obviously a regulatory and audit certainty. All these discoms, etc., power sector is actually very heavily regulated. So if discoms, they have to go to their regulators for every approval, etc., for their revenue requirements and all those things. Whatever buy sell they do, they have to take permission from the regulator. Now these entities may start fearing this scrutiny, or there right now there is no clarity on how to even account for such transaction. If, for example, if Delhi discoms do a trade in particular derivative and they make a loss, how do they justify this to regulators? Where are the guidelines? These guidelines right now are missing, and they need to come, which I'm sure will come once the this capacity building thing happens. So one of the overall the biggest challenge which I see is not the derivative itself, but the lack of ecosystem to support this market, lack of trading depth, and very important, the institutional capacity and confidences in this market.
Mhm. In your previous answers, you mentioned mature markets like Europe and North America. So, how does India's initial approach to electricity derivatives compare with these markets? And what issues are worth applying here? Or lessons are worth applying here?
Yeah, correct. So, India is at a stage of evolution where these mature market, for example, Nord Pool was around 15-20 years back. And there are some, I mean, if you compare their market with our market right now, I mean, I don't think that is a fair comparison, because they have these 15-20 years worth experience. For example, they have multiple type of contracts available. Their contract settlement happens at nodal pricing, for example. Here the exchange prices are not nodal, they are on a regional basis. In their market, the participation is huge. All the utilities, large consumer traders, financial investors, everybody routinely use derivatives. In our market, let's see what happens. But I keen to start with the participation would be limited, especially from discoms. But the second part of your question is very important, that what lessons can we draw from them, right? So what they did right at the initial stage was, for example, Nordbook. What they said was, they told their utilities, their big utilities, for example, Statkraft in Norway, which is the biggest utility, power utility in Norway. They were asked to mandatorily participate in these markets, right? Uh, for example, many of the generation assets of these big utilities were being sold into spot market. Some of them were tied up under the long-term PPAs, but some of them were exposed to spot market. So these guys were asked to mandatorily participate, in these in these derivative market. So this helped in two ways. It built enough liquidity, because when the bigger utilities are participating, obviously they bring volume, right? And and it also increased confidence in other stakeholders, that okay, if these reputed big utilities are coming into the market, this means that market is well functioning, right? Then what they also did was, they developed some sort of forward curves. So forward curves are nothing but some sort of price forecast. So in derivatives, basically, where does this risk arise from? Because because if I had this 100% certainty that next month the prices are going to be, say, 5 rupees, I would be very happy to not to buy any derivatives or all those things. So these forward curves, this price forecasting is a big exercise in itself. Not everyone can do it, right? And basically, usually for small consumers or for discoms, etc., which or avoid single out discoms, other players in Indian market also. Not all of them has this big price forecasting market analysis teams working for them. So how do they participate in the market then? So there, these guys, the regulators, etc., they started publishing these forward curves. So these forward curves help participants to forecast, plan, and secure their finances. So this also, these if people have trust on these forward curves, they can then decide, okay, the price movement is going to be like this. I need to, manage my bid strategy accordingly. They also allowed physical and financial convergence. So, for example, in mature markets in Nord Pool, a trader can hedge both financial and physical position at same time. Here, when we are starting, the MCX settlement and IX settlement, or for that matter, any other power exchange settlement, will happen. There is no linkage between them. You have to, participate in this market separately. So, what this means is, you have to have margin money. You have to pay this margin money to both these exchanges, one to IX, one to MCX. So this increases financial cost for the participants. So if it can happen that there is only one clearing house which clears both these bids, and I have to deposit only once the margin money, so that would be great. So these are two, three things which we need to do, which I think regulators and other participants understand, and these things will be implemented in future.
Got it. One last question that I have is, what key developments in regulatory structure or technological space do you foresee in the next 3 to 5 years that could shape this new market?
So first, of course, I foresee that right now the contracts which are being launched are basically monthly contracts, and you can bid only, I guess, 4 months in advance. So if you are in July, you can buy future contracts for delivering in for settlement in October only. So in effect, you can plan only 4 months in advance. So what I foresee is that once the market matures, the contract duration would increase. So, for example, you can have multi-year contracts also, or to have a 1 year contract, for example, or quarterly contracts also. Second, the type of contracts will also evolve. Right now, if I am a solar generator, so this doesn't help me much, because why? Because right now, what my limited understanding is that I cannot buy futures only for solar hours. You have to buy a future for all 20%. Settlement is for average power exchange prices for, or for RTC average prices. So I'm not concerned with RTC prices. As a solar generator, my concern is only for solar hours. So such type of contracts will come when some contracts which are specific only to renewable energy, specific to solar, specific to wind generators. They will index these products to generation patterns of solar and wind. So what it will do, it will help me as a RE generator to manage my RE specific risks. Other type of contracts may also come where only if I want to hedge only say peak prices, that can be possible. Third important thing which should happen, I guess, is more and more discom participation. Discom participation would increase in 3 to 5 years when things are institution capabilities are built and things are much more clearer. And discoms are expected to enter the market as core hedgers, right? Then forward curve development, of course, as participation will deepen, credible multi-month forward price signals will emerge. So, right. So sitting in this month of July, I will have a credible price signal that for rest of the year, how prices are expected to behave. And this will help me in planning and financing my projects. So in a nutshell, we are at a place where global markets were 15 to 20 years ago. And with right policy and design choices, we can scale rapidly and build a very financially resilient market for our grid.
Got it. That would be all, Mr. Vijay. So I was a bit confused about this new market, but now from your answers, I've got a very thorough understanding. Thank you very much.
Thank you, Shivani. Thank you.